Welcome everyone to our Marcum podcast on tax implications for individuals under the Tax Cuts and Jobs Act. I will be your discussion moderator with respect to the individual changes, followed by Ron Finkelstein, who will be handling estate and trust information. So as you can see on the first slide, I start with understanding the negatives and then maximizing the positives, and that's because on the individual side of the Tax Cuts and Jobs Act, many of the negatives ended up on the individual side of the ledger. Okay, so this is the outline of what we're going to address quickly today. You will see in these slides that we do not have what you often see in presentations, which is all the charts, the tax brackets, and lots of numbers. There are a lot of numbers, a lot of thresholds, and a lot of limitations that apply on the individual tax side. If you need those charts or that information, you can either go to the IRS website or the Marcum tax portal and download that information. So we're going to talk about how we got here, what the changes are, what our opportunities might be going forward, and what we need to watch out for. So we got here on the individual tax side sort of as the stepchild. And as we know, Congress and the President emphasized corporate and pass-through tax savings and only made changes on the individual side that fit either within the budget cap or actually raise revenue. So some of the changes that we have on the individual side, such as the disallowance of a lot of deductions and the elimination of certain benefits that individuals had before, are intended to raise revenue to offset the tax savings granted to corporations. So there are many of us who say that this was blue states versus red states, the blue states, of course, being the Democrat states and the red states being the Republican states. You could also say it's East Coast and West Coast versus the middle of America. But it's really more, if you look at it, it's more of where can the dollars come from if we need to raise revenue? And how do we raise revenue while giving tax benefits to those who might help expand the economy? So the cumulative changes were all adopted to meet the budget threshold under the Senate reconciliation process, and the individual changes flowed through because Congress and the President were committed to the pass-through and corporate changes as the key driver of this entire tax plan. Okay, so on the negative changes, and we're really going to talk quickly about the negative changes and even about the positive changes, because you really need to get a sense of the entire picture for individual taxpayers. So personal exemptions have been eliminated. The big one, of course, is that state and local income and real estate taxes are now limited to $10,000. State and local income and real estate taxes are not limited if they are reportable in connection with a business or investment property that are typically reported on non-1040s, Schedule C, E, or F. The mortgage interest deduction is limited for new debt after December 15, 2017. It's limited to the interest allocable to $750,000 of debt, and there will be some guidance as to how debt is treated if it is refinanced and extended after December 15, 2017. Many of us have had a great deal of flexibility managing our debt through the use of the home equity loans. Effective immediately, no home equity interest deduction will be allowed, but that, of course, does not mean that we cannot take a deduction with respect to our home equity loans if we can trace the use of those funds to investments or business activities, in which case we can report them as investment interest expense, business interest expense, or on a separate Schedule C, E, F, or separate return. There's also been a change made to disallow charitable deductions for payments to universities for the right to purchase athletic event tickets. Hopefully there will be no changes the way universities charge for these things in terms of you make your charitable donation and then all of a sudden you get free event tickets. That would seem to be a problem. Okay, on the next slide we start with casualty and theft losses. Now I view casualty and theft losses as, in many cases, unavoidable expenditures. Is it right that they're no longer deductible, except for federally declared disaster areas? You can pass your own judgment on that. Here in the New York area over the past few years, many of our clients and taxpayers have been subject to Ponzi loss schemes. There have been very generous federal and state benefits granted to those victims. Under the new statutes, casualty and theft losses will only be allowable for federally declared disaster areas. As you can see, the 2% miscellaneous itemized deductions have been repealed. These are typically investment fees, tax preparation expenses, certain estate deductions, along with unreimbursed employee expenses. To minimize the pain on the disallowance of unreimbursed employee expenses, you can consider entering into accountable reimbursement plans with your employer, and maybe that will help a little bit. The moving expense deduction has been repealed, except with respect to military moves, and the alimony rules still remain in effect through the end of this year, but starting next year, January 1, 2019 and forward, there will be no deduction to the payer of alimony and no income to the payee. This section was added to the code because the congressman felt that many of the recipients of alimony were not properly reporting the alimony as income, and those that actually did ended up paying a lower tax burden than the benefit that was received by the payors. So this statute made it into the Tax Cut and Jobs Act. The Roth IRA reconversion strategy had been utilized to give us all a bit of flexibility if we converted our IRA account into a Roth IRA account, but for tax purposes or due to poor investment performance, we decided to reconvert it back to a regular IRA. That could have been done in the subsequent year. Effective for conversions in 2018 and forward, that reconversion back to a regular IRA will no longer be permitted. The NOL carry forwards for individuals previously allowed you to offset all of your income against all of your NOL. Now the NOL limitation is 80% of your offsettable income. So if you have an NOL carry forward and you have the limitation apply, you will indeed pay some tax. The kiddie tax rule changes are kind of interesting. They were a bit confusing before because you had to accumulate all of your children's income tax information, analyze it together with your own, and determine which tax rates applied and how much the exemption was for each child. Now, children who must file under the kiddie tax must file their own tax returns. They will each have their own exemption for unearned income of $1,050, and the next $1,050 is taxed at the child's effective rate, and after that, it's going to be taxed at the estate and trust rate. So it's just an extra set of tax returns. No longer will children's income be reportable on the parents' tax returns. There are some positive changes. I don't want to be all doom and gloom. There are some slight rate bracket reductions, and we all have heard about the increased standard deduction to $24,000. By increasing the standard deduction to this amount, it is believed that millions of taxpayers will no longer be required to itemize their deductions. There is also some concern that people will cut back on their charitable deductions because many taxpayers combined deductions for income tax, real estate tax, and charity does not reach $24,000. So it will make filing simpler for those individuals, but for those who are in the higher income brackets and pay high estate income taxes and have lots of deductions that are still deductible, it may make sense to bunch up your income tax deductions in one tax year to get over the $24,000 threshold, and then use the $24,000 standard deductions in a different tax year. The AMT exemption has been increased, but if you're losing your state income and real estate taxes, along with your unreimbursed itemized deductions, does it really matter? It may not matter for most individuals, but they will be paying higher income tax because the AMT rate will not apply and because you simply will not have the benefit of any of those now disallowed deductions. One of the real benefits in the Tax Cuts and Jobs Act has been the increased medical expense deduction that will now be allowed. This has been affected by decreasing to 7.5% of AGI the limitation for medical expense phase-outs for 2017 and 18. The medical expense threshold will go back to 10% for 2019. There has been a significant enhancement of the child care credit. It has been increased from $1,000 to $2,000, and the refundable portion is $1,400. But most importantly, the phase-out for not being allowed to take the credit has been increased to $400,000 from, I believe, $105,000. So that is a real benefit to families with children, and the $400,000 phase-out is intended to make sure that more families gain the benefit of the child care credit. We've heard a lot about changes to 529 plans. The only real significant change has been that you can now utilize $10,000 per year per student for private kindergarten through 12th grade. That's a real benefit for those who are using private schools and can afford to make payments from their 529 plan. As you can see, a charitable contribution limitation has been increased to 60% of AGI for the phase-out and carryover. The P's limitation has been suspended. That is the limitation based upon adjusted gross income. And as Ron will be addressing, there is a significantly increased gift and estate tax exemption. The pass-through business deduction is a real benefit for pass-through S corporations, LLCs, and sole proprietors. That is discussed here, but it is not the subject of this discussion. That was covered in our corporate discussion, and more information on that is available on our website. The most important thing to note that if you really pay attention to the details of the deduction, that you will hopefully come to realize that Congress expected the economy to expand and wages and business income to increase so as to pass through financial growth and economic stimulation to all of us as individual taxpayers. So we do have some planning opportunities. I do personally wish there were more of them. We had thought at the end of 2017 that we could prepay our state income tax for 2018. We actually made some plans to do so and were correct until Congress specifically provided by statute that you could not prepay your income tax. They did not make that same statutory change for real estate tax, but they have been issuing guidance that prepayment of 2018 real estate tax could only have been occurred in cases where the real estate tax has been assessed by local governments. That may still be an issue going forward, but the service has said they will take a hard line on that, but let's await further guidance. As a result of the change in the pass-throughs and C corporation tax calculations, all of us as individuals must also consider the choice of the business entities that we use. Any entity savings that might occur due to the qualified business deductions will ultimately flow through to each of us as individuals. And in that regard, if you are in a non-specified business line, you may be able to peel off any specified business lines and segregate businesses that would receive the deduction from businesses that might not receive the deduction. So we're always looking for a little bit of an angle to take some tax deductions that might otherwise not be available. Vacation homes will be allocated mortgage interest and real estate tax to the extent they are used as rental properties, and similar allocations can be made with respect to a home office. So going forward, we're going to continue to utilize many of the historical tax planning concepts that we have used in the past. This list on this slide gives just a couple of these. I point out that the use of donor-advised funds helps you bunch up your charitable deductions. That goes along with the bullet ahead of that, which tells you to bunch up your other deductions to exceed $24,000 and maximize your deductions where possible in business entities or on Schedules C, E, and F. These new tax laws are pretty complicated, and there are a lot of inconsistencies. By working with the statutes and in conjunction with IRS guidance, we will all get a better picture of how 2018 may turn out. If you are unsure of a position, consider disclosing it on your 2018 tax return. Obviously, discuss it with your tax preparer. In that regard, if you are wrong and you take an erroneous business income tax deduction, higher penalties might apply, so you do want to get that right. I have not addressed anything about state and local taxes, but most state and local taxes start with federal taxable income. From there, they take certain deductions or adjustments. If states do not actually change their tax statutes, they will end up adopting all of these federal changes and will probably result in significant additional tax liabilities for all their state taxpayers. California, New York, Massachusetts, New Jersey governors are all dealing with these issues, and we expect guidance and statutory changes to be coming soon. To fit within the budgetary constraints of reconciliation, most of the individual tax changes sunset on December 31, 2025. The next day they come back just as they were before. So we as tax advisors still must put in the back of our minds all those rules and regulations that we now are putting aside for this 8-year period. In addition, some provisions phase in, such as alimony on January 1, 2019, and there are, as addressed, the changes for medical expense, which come back again on January 1, 2019. So there's a lot to learn, there's a lot to plan for, and there's a lot of extra guidance we expect to get shortly from the Internal Revenue Service. So thank you for your attention on this area. Please feel free to email any questions you may have, and we will address them at the end of the session. And now, please welcome Ronald Finkelstein.
Thanks, Bob. Hi, my name is Ron Finkelstein. I am a tax partner in the Melville office of Marcum and a co-chair of the Trust and Estates Practice Group. Today I'm going to be addressing the transfer tax issues and estate planning considerations under the Tax Cut and Jobs Act. Okay, so first let's look at the changes under the new law. The Act doubles the estate and gift tax exclusion amount for estates of decedents dying and gifts made after December 31st, 2017 and before January 1st, 2026. So just like the individual changes, this change in the exemption is not permanent, unlike the corporate changes, which are. It will revert back after January 1st, 2026. So basically what's going to happen in 2017, the exemption amount was $5,490,000, and if the law did not change in 2018 based upon inflation adjustments, that amount would have been indexed for inflation at about $5,600,000. And that inflation adjustment will continue, and whatever that inflation adjusted amount would be in 2026 will be the amount of the exemption once the law reverts back to the old exemption amount. The generation skipping transfer tax exemption is also doubled, and as of January 1st, 2018, the exemption is now $11,180,000 per person and $22,360,000 for a married couple, and that's based upon doubling the exemption and generating it for inflation beginning after 2011. Okay, other things that are important to focus on are that the estate, gift, and GST tax rate remains at 40%. The exclusion amount, which I just mentioned, is indexed annually for inflation, and of very much importance is that inherited property will continue to get a stepped-up basis at death to fair market value. And not only this is always important, but when we have a lot more people that are not subject to an estate or a transfer tax upon death, the income tax planning and getting a stepped-up basis is very important, and we'll talk about that in a few minutes. The annual gift tax exclusion amount increased in 2018 to $15,000 from $14,000 in 2017. So just before we move on, I mentioned that the law reverts back as of January 1st, 2026, but as we're all aware, laws are effective until they're actually changed. So can these laws change prior to that date? Well, of course. There can be a new administration, there can be a new president in 2021, and as remember, back then, the Democratic presidential candidate was looking for a $3.5 million exemption. So there can be changes between now and 2026, which could reduce the exemption. So just keep that in mind when you're doing your planning and determining whether you should wait, to use the balance of your exemption or do something prior to the 2026 deadline. Okay, some of the income tax provisions that are relevant for trusts and estates is generally that the tax provisions for individuals apply to trusts and estates. So the $10,000 limitation on deducting state and local income taxes also applies to trusts and estates. And also, miscellaneous itemized deductions are not allowed as well. So investment advisory fees that typically fall into this 2% limitation will not be allowed for trusts and estates, as it's not allowed for individuals. Other miscellaneous estate or trust expenses that are not subject to the 2% limitation will still be allowed. And those things which have separate lines on the 1041 and are not in the 2% line on a 1041 form include executor and trustees fees, accounting and legal fees, and deductions for estate administration expenses that would only be incurred if you had a trust or an estate, such as appraisal fees or court fees that you would not typically have, unless someone died and these expenses are incurred. Okay, so some of the estate planning considerations are that fewer decedents will have to pay an estate tax in 2018 and future years until the exemption goes back to the older amount in 2026. You should review formula clauses in your wills. If you have wills that provide that the amount up to the exemption goes into a credit trust, that may not be what you want to have now. So you need to look at formula clauses in wills and make sure that they make sense based upon this increased exclusion amount. And you also need to review state estate tax consequences as well. Now, New Jersey eliminated their estate tax very recently, but they still have an inheritance tax. And this was done when there was a Republican governor. Now that there's a Democratic governor, the New Jersey estate tax could come back. In New York, the exemption amount in 2019 was scheduled to equal the federal exemption amount, but that was prior to the changes in the federal tax law. So in 2019, when the exemption amount for New York increases, it will only be based upon the old law, and it'll probably be around $5.9 million, whatever that inflation-adjusted amount will be in 2019. Okay, so when we're looking at planning, we basically have three different buckets that we need to look at. The first bucket is, what are we doing for people that have net worth that's less than one basic exclusion amount, or up to $11.2 million under the current law. In my slides say the $5.5 million. There's always like to look back at the current law because we're going to revert back to that after 2026. And then the second bucket is, what are we going to do for planning where under the current law we have more than the one exclusion amount of 11.2, but not more than the 22.4 million under the current law, and again 11 point whatever under the law when it reverts back. And the third bucket when we're over more than the $22.4 million for a married couple under the current law. So if we fall in the first bucket, which under the old law was $5.5 million, for one exemption and 11 for two, and now is 11.2 million per person. We really don't have to worry about estate tax planning because we're going to fall for both estates under the exemption amount. So we shouldn't be driven by tax planning when we want to make our decisions. The couple should look at whether they want to leave assets outright to a surviving spouse or in trust, and look at non-tax reasons when they're making the decision. You know, is the surviving spouse possibly vulnerable to creditors where the trust would make sense? You know, is this a second marriage, so the first spouse to die wants to control the disposition of assets upon the surviving spouse's death? Again, the trust would make sense. Or does it not matter, and better to leave the assets outright to the surviving spouse? The second thing to look at is step up on the first and second death in the basis of the assets. So if we don't have estates that are going to be subject to estate tax, and we have low basis assets in our estate, we don't necessarily want to give away those low basis assets to our children during our lifetimes, because they will get carryover basis, they will get your basis, which will be either a low or a zero basis or whatever it is, and when they sell that asset, they will have an income tax on that sale based upon the fair market value compared to your basis. But if you retain low basis assets until your death, you will not have an estate tax on your death because you're below the exclusion amount, and you will get a step up in basis on all your assets. So we want to make sure that when we're not subject to estate taxes, that we maximize the step up in basis on the surviving spouse's death. Obviously, if we have outright gifts to the surviving spouse, this will be achieved. If we put assets in a trust, then we need to make sure that the trust is includable in the surviving spouse's death, either by giving a power of appointment, or having a Q-tip trust. Okay, so that's very important. Now, if we're below the 11.2 million under the current law for both the husband and wife can combine assets, we don't have to worry about electing portability, but electing portability may not be a bad idea. You don't know what's going to happen with the surge in the markets. You may win the lottery and then be over the exemption amount. So you may want to consider making a portability election, and based upon the relaxed requirements in doing that, where you can just file an estate tax return and don't have to put in, get formal valuations for all the assets, you can elect portability under these relaxed requirements. The most difficult planning is going to be for those people that fall within, for a married couple, that falls within the one exclusion amount of 11.2 and the two exclusion amounts of 22.4. And again, my slides reference the prior law because the law is going to change back. And when you're going to look at your documents and how you're going to draft, you need to be conscious of the fact that we're possibly going to go back to the lesser exclusion amounts. So when we fall into this category, we need to take advantage of portability or look at credit shelter trust planning, and we need to be as flexible as we can when we're doing our planning. So if we do nothing and we have more than the one exclusion amount, the second spouse is going to be subject to an estate tax because we're going to waste the ensuing amount. So we need to either elect portability or have some sort of credit shelter trust. And without getting into a lot of details on how we need to do the planning, we need to be flexible in what we're going to do. So if we want to leave our assets outright to the surviving spouse, then we should consider disclaimer planning, where if the surviving spouse wants to get the assets outright, she can not elect to have a disclaimer. But if a credit shelter trust makes sense upon the death of the first spouse, she can exercise this disclaimer and have part of all the assets fall within a credit shelter trust. If it makes sense to leave assets to a surviving spouse in trust, then we would want to look at what's called Clayton Q-tip trusts, where we can make an election on a timely filed estate tax return to either make all or a portion of the trust amounts subject to a Q-tip election or not subject to a Q-tip election, so it goes into a credit shelter trust and not subject to estate tax in the surviving spouse's estate. One important thing to remember about portability is that the generation skipping transfer tax exemption is not subject to portability. So if you want to do GST planning, you need to do something and not rely on portability. And in the last category, we're looking at married couples that have more than the double exclusion amount of the $22.4 million under the current law and under the prior law and the law that will go back into effect after 2026 of $11 million. And for those people, they want to consider using the increased gift tax exemption currently or before it reverts back so that they can take advantage of the excess exemption amount in case that amount is not made permanent either in a date in the future or before 2026. So now not every couple is in a position to take advantage of the full exclusion amount. They may only have $20 or $25 million of assets and not comfortable making the full exemption amount. You know, other couples may have $100 million of assets or 50 and may be more of a position to take advantage of the increased exemption amount in full. But some of the things to look at for everyone is, you know, what happens if you have some outstanding loans to family members, to your children? Well, that's not going to take assets away from you if you just forgive those loans. So forgiveness of outstanding loans is a good way to use your increased lifetime exemption. If you set up trust for grandchildren, you know, 5 years ago, funding it with the annual exclusion amount, and then you have a new grandchild now, so they have a lesser amount in that trust, or for children as well, you may want to look at using the increased exemption amount to equalizing the gifts you've made to children and grandchildren over, you know, their lifetimes. And look at ways to save state estate taxes if using the increased exemption amount makes sense for that. Now, the strategies that we use to take advantage of the increased exemption amount have not changed. And to the extent you already have trusts set up that you use to use your exemption amount under the prior law, you can just add to that. So if you have a spousal lifetime access trust, or if you've already set up a dynasty trust, you can look to fund that with more of your exemption amount. You can always use grantor retained annuity trusts, which is a good strategy to take advantage of getting more of the appreciation out of your estate. We have intra-family loans, sales to intentionally defective grantor trusts, and as also important, is not as much an estate planning strategy, but something to be conscious of, since we all have retirement accounts, is that we want to make sure that when we're doing our designated beneficiaries of our retirement accounts, whether they be 401ks or IRAs, that we make sure to name an individual as a beneficiary so that upon the death of the IRA account holder, that the beneficiary can stretch the payments out over their remaining life expectancy and pay the least amount of income tax on that money, because the distributions from retirement accounts as well as the fair market value are subject to both an estate tax and an income tax on the death of the IRA holder, and then subsequently when the distributions come out. Okay? Some of the other considerations are that if we do any additional estate planning, we want to make sure that we report the transactions on gift tax returns, and we do it with adequate disclosure. because if we don't report them and we don't adequately disclose the gifts and have appraisals when they're needed, then the statute of limitations on the IRS auditing these transactions does not run. And then if you die 20 years later, they still can be audited. So we want to make sure that we close the statute of limitations by filing returns and adequately disclosing. We want to think twice before we gift away low basis assets, because to the extent we don't have an estate tax on death and we have low basis assets, we won't pay an estate tax, but we will also get a step up in basis on these assets so that our beneficiaries will inherit them with a basis equal to the fair market value at the time of death. And lastly, always be sure a decedent's planning ensures assets pass to whom they wish, when they wish, at the lowest estate and gift tax cost, while maximizing income tax opportunities. So every 3 to 5 years, look at your wills, make sure you're giving assets to the people you want to, make sure your plan makes sense from both a non-tax perspective and from a transfer and income tax perspective as well. And Bob, do you want to summarize, or are you going to do the conclusion?
Thank you, Ronald. As you can see, the new law is deceptively complex in many respects. That applies to business changes, individual changes, international changes, and certainly the uncertainty with respect to the estate and gift changes. The IRS, as I'm sure we all appreciate, is scrambling to provide guidance. Guidance can come in the form of regulations, rulings, opinions, and what they call FAQs, frequently asked questions. Generally, frequently asked question guidance comes quicker, and I suspect that will be coming before rulings and regulations. So it's important to understand the law, its implications, and the specific facts, and be able to put them all together to plan effectively. That's what we do at Marcum. If you have any questions, just ask Marcum, and we're going to respond to some of your questions now. If we do run out of time, we apologize. We will try to get to all the questions. Let me start with answering a few of the questions on the individual side. The first question I received was on the home sale exclusion. When you sell your principal residence, is there any change under the new tax law? And the answer is, the new tax law did not include any provisions changing or limiting the rules on the home sale exclusion. So long as you live in the home as a principal residence for 2 of the prior 5 tax years, you can exclude $500,000 of gain on a joint return and $250,000 on a single return. For multiple properties, what you need to do is you need to time out where you live, and whichever one applies to the 2 of 5 year test is the one that you can receive an exemption on. Second home interest, vacation home interest, is deductible under the $750,000 revised mortgage threshold. And home equity loan indebtedness is not deductible unless it is related to an acquisition. That needs to be checked. I believe that is the answer. The $10,000 Schedule A limitation for state and local income and real estate taxes is $10,000 on a joint return, and I believe it is $5,000 on a single return. It is not $10,000 per person. A question has been asked on how we can deduct interest incurred on a home equity loan. Well, we do know that home equity loans now that are utilized for personal purposes, the interest is not deductible related to personal purposes. But there has been no change in the rules on tracing interest to the use of the monies borrowed under the HELOC. So if you've borrowed money under your home equity loan and made investments with it, the allocable percentage of the interest expense will be reported as investment interest expense. If you've acquired rental real estate, it would be reportable as a rental real estate interest expense. And if you ended up buying bonds with it, taxable bonds, you get a deduction as investment interest expense. And if you bought tax-exempt bonds, we all know that we're limited and cannot deduct interest expense utilized to acquire tax-exempt bonds. Moving on, a question has been asked if the disallowance of employee expenses will be a major hit to those employees, since an employer would be hesitant to reimburse for high expense requests from employees. Yes, that would be a problem. If you have a position where you are required to incur a great deal of expense, now it is not deductible. It would be incumbent upon you to enter into an accountable reimbursement plan with the employer so that you could be made whole. As far as the home equity line is concerned, any current home equity line interest in 2018 is not deductible unless you can trace it. There is no grandfathering. There are many things that have not been changed in the tax law by this new bill. One of those is the tax treatment of long-term care payments. So if you receive a long-term care payment, it will be reported to you on Form 1099. Payments received under a long-term care plan are treated as similar to medical expense reimbursements, and as long as you have incurred those expenses, you will not be taxable on the proceeds. So if you receive a 1099 showing $10,000 of long-term care payments, and you paid an aid worker, a caregiver, $10,000, you have no taxable income. Ron, you ready?
Yeah, let me take a couple questions. I only have two here.
There's a couple more on the yellow sheet that I just added.
Okay. Does the miscellaneous deductions not subject to 2% limitations, such as executives' fees, which are allowable, also allowable to beneficiaries on the final K-1 allocations for Schedule A of Form 1040? It's a good question. I haven't looked into it yet, but I believe that excess deductions on termination of an estate flow to Schedule A in the subject to the 2% limitation category. So if that's the case, and you can just double check that, then you would not get the benefit of excess deductions on termination of an estate. I believe that IRD deductions, when they're on an individual return, are not subject to the 2% limitation on Schedule A, so I believe IRD deductions would still flow through. Another question is, I have a client who was a U.S. citizen. Her father resided in India, passed away in 2017, and she inherited a fortune. Is there any limitation on the amount she can bring from India in any form that she needs to be reported? Well, that question's a little bit beyond the scope of this discussion. I'm not familiar with the laws on how much you can bring in from India, but there certainly are reporting requirements for U.S. citizens who receive money from overseas people. I don't want to give you advice, but I would look into Form 3520 as a starter and the instructions for that, because not following those forms are subject to significant penalties. Has the lifetime gift tax exclusion been increased to 11.2 as indexed for 8 years? That's correct. The increased exclusion amount implies for estate tax on death, gift taxes during your lifetime, and for the GST exemption as well. That's the same amount for all three, which increased to the $11,180,000 under the current law and continues to be indexed for inflation. All right, Bob, you want to?
Thanks, Ron. A couple more quick questions with some quick answers. The alimony deduction is eliminated effective January 1, 2019. However, it only applies to alimony agreements that become effective and approved by the court after January 1, 2019. So anything that happens through the end of December 31, 2018 still will qualify under the current alimony rules. One of the participants asks to address how he can deduct or she can deduct interest on HELOC loans. I think I've covered that in terms of allocating the use of the money received from the HELOC into categories where the interest expense thereon would be deductible, such as for business activities, investment activities, or otherwise reportable on Schedule C, E, or F. We have more questions coming in. Does a refinance loan follow the new tax law? And the answer is it does, but we're still waiting for guidance. Let's assume you have a $1 million mortgage that is due in its entirety by 2025, and you refinance that mortgage for $1 million, and it goes all the way out to 2040. Is that a new loan? Well, it's got a significantly increased term, and we don't know if that will be grandfathered at this point. So the number is still $750 for new loans. It may be that if you had a $1 million loan that is going out to 2025, and you refinance for a loan going out to 2040, that you might be limited to $750. That's a good question. There is no answer yet. We have to wait for IRS guidance.
Let me take a couple.
Sure.
Okay. How is a SLAT different from a marital trust? Well, they are different. The reason people set up SLATs when they wanted to take advantage of the increased exemption amount is because if they weren't comfortable with giving away the assets in their entirety and losing complete control, a husband and a wife could set up a SLAT, which is basically a grantor trust, and they can't be identical in nature. You can't have the exact same terms in a SLAT, but the SLAT allows you to put in your spouse as a discretionary beneficiary so that to the extent you needed some of the income or some of the principal back from the trust that you made a gift to, you can include your spouse as a beneficiary. So that's one of the benefits of setting up a SLAT and makes it a little bit different from just setting up a marital trust. They're really identical trusts that a husband and wife would set up. Doesn't the new law require the IRS to issue no clawback regulations? Well, I don't know if they can issue regulations saying there is no clawback, but there certainly is going to be some sort of guidance with respect to whether there is a clawback. I assume that'll be forthcoming, who knows when, but we'll definitely have some regulations or some sort of guidance on what's going to happen when the exemption goes back and you've used more than the current, the prior exemption amount during your lifetime. And the last question I have here is foreign assets of a U.S. citizen. How to include the foreign assets in estate planning? Well, if you've inherited these assets and they're part of your estate now, if you are a U.S. citizen, you are subject to estate tax on all your assets regardless of where they're located. So they are part of your estate and you need to dispose of them accordingly. I'm not expert in telling you how to dispose of them, but you may want to look into, if they're located in a foreign country, whether you need to have an additional document other than your U.S. will to dispose of them, but that's beyond the conversation that we can have here today.
So the last question that I will address is a very good question, because it demonstrates that those who are participants on the call are thinking about workarounds about the problems that these new tax statutes and limitations present. And the question is, can you transfer your personal residence to an LLC, rent it from the LLC, and secure a property tax deduction without a limit? And the answer is probably not. Creating an LLC and operating it as a business is different than using it simply to co-own property. So if you are putting your own residence into an LLC and leasing it back, really what you've done is you've just taken your property and put it in one pocket from another, and you've simply taken all of your expenditures for that property and made it paid from a separate checking account, but when you collapse the whole transaction, it is all the same thing. That might be different if you actually gift or sell your home to a wholly owned S corporation or to your children, but it's getting into an area that we know that the service is going to attack, because they have stated that they will look at very carefully any strategy that is developed to get around the limitations that have been imposed on the limitation for state and local income and real estate taxes. So with that said, Ron and I thank you for your attendance and diligence and your questions. I pass it back to Erica.
So I actually have one more question, and then we'll wrap this up. If I received a 2018 Philadelphia real estate tax bill in December 2017 and paid it in 2017, is this deductible in 2017?
The answer should be yes, because if you received a bill, that probably means that they have assessed the tax. Right now, we're in 2018. You have already, I assume, made the payment. So your tax return for 17 will be due on April 15, 2018. Between now and then, or even if you need to extend it, your tax preparer can give you better guidance. But this seems to be one of the things that there is no further action steps for you to take. The fact is that you've made the payment. Now your advisor just needs to confirm whether or not it is a good deduction for you.
Thank you very much. Have a great day, everyone.